Okay, we're recording. It's all yours.
All right. So my name is Dominisha. I'm one of the student advisors with the Scholarship Foundation of St. Louis. And Teresa, do you want to introduce yourself? And then I'll share a little bit about who the Scholarship Foundation is.
Yeah, my name is Teresa Steinkamp. I'm the advising director at the Scholarship Foundation. Thanks, Dominisha.
Cool. So the Scholarship Foundation of St. Louis is a 100-year-old non-for-profit organization that believes that an educated society is essential to a healthy democracy. And the foundation started off with one interest-free student loan to help a student go to school. And we have since then expanded into grant programs as well. At the foundation, we do three main things, and we like to call them our 3 A's. The first is our awarding. The foundation has awarded about $5 million to 500 students annually in the form of our interest-free loans, scholarships, grants, and paid internship, all which are need-based and last dollar. The second A is advising, where we provide guidance and support to students and families as they navigate the admissions and financial aid system of higher education. And through our advising program, we serve about 6,000 students every year with need-to-know information and accompany to and through their journey of post-secondary education. And then our third A is advocacy, where we engage with students and recent graduates to identify, analyze, and lead efforts to influence policy that affect them on the school, state, and federal level. So thank you all for joining us. We will be talking about the lending life cycle, so student loans from acceptance to repayment. And I will go ahead and share with you our objectives. So first, we're gonna review some key terms to make sure we're on the same page and we're talking about things related to student loans. Then we will talk about the different borrowing options that are out there for students. We'll also discuss your rights. What are your rights? And then also discuss student loan repayment options. So our first key term is student loans. So there are 4 different types of financial aid out there. You have your grants and scholarships, which are free money. Then you also have your self-help aid, which is work study, and then your loans. One special characteristic about student loans is that that is a type of financial aid that you do have to pay back. And then they can be sourced from the federal government, a private bank, or even a charitable organization. And then also your loans may have interest associated with them, so interest charges. And what the interest rate are, just in case, is the amount that you're charged to borrow money. So when you look at your federal subsidized and unsubsidized Stafford loan that were borrowed during this academic school year, 2021 and 2022, those loans will have a fixed interest rate of 2.75. And the interest rate for your federal loans will be recalculated every year on July 1st. So be aware that if you are a student that's taken out student loans one year after the other, so for example, if you borrowed a subsidized loan your freshman year and a subsidized loan your second year, those 2 loans, which are the same type of loans, may have different interest rates year after year. And on this chart, you can see historically what the interest rates have been starting from 2015-16 all the way until the current academic year, 2020-2021. And so as you go over left to right, you'll see the Stafford subsidized loan, the unsubsidized Stafford loan, and then the plus loan in the last column. And you can see year after year, those interest rates have changed. They have gone up, they have also decreased. And then you'll also notice that for 2020, 2021, those interest rates are a lot lower than they have been for several years. Something else I want to point out that is not on this chart, but the last column, you see the Parent Plus loan. I do want to point out that for students that are in graduate school, the plus loan is maybe an option for them as well. And when made out to graduate students or students that are pursuing a professional degree, it's also called the Grad Plus loan. All right, so our next key term is the promissory note, which is a document that you'll have to sign before your loans will be dispersed to you. It is a legal document, you as a borrower promising to pay back that loan. And then also that promissory note should provide information about the terms and conditions of your loans, such as the interest rate. All right, so our next key term is the grace period, which is the time between being in school or receiving a loan until the point in which you are expected to start paying back that loan. And your grace period for some loans may start after you graduate, after you leave school, or drop below half-time enrollment. And for your federal subsidized and unsubsidized student loans, you'll have a 6-month grace period. So you'll have a little time between the time you graduate or leave school to maybe find employment before you're expected to start paying back those loans. So next up is deferment and forbearance, which is a temporary pause in the payment of your loans. And so there are 2 different types of forbearance. There are some circumstances that you have to meet, so they're only allowed under certain conditions. And the 2 different types of forbearance available to borrowers for federal loans is a general forbearance, where the servicer would have a discretion to approve or deny your request. And then you also have what's called a mandatory forbearance, where the loan servicer is required to grant you a forbearance if you're meeting one of the eligible requirements. And some of those eligible requirements would include participating in AmeriCorps, being in the Department of Defense Student Loan Repayment Program, or if you're someone that's doing a medical or dental residency. Also, if the total amount you owe each year for federal loans is 20% or more than your total monthly gross income, or if you are a teacher, that would qualify for a teacher loan, the Teacher Loan Forgiveness Program. Deferment, which is also a temporary pause of your loan repayment, but with a deferment, you may not be charged interest while you're in a deferment, but a forbearance, you are likely to be charged interest during that time. And you can apply for a deferment or forbearance through your loan servicer. And you can figure out exactly who your loan servicer is by logging into the Federal Student Aid website using your FSA username and password that you would use to complete your FAFSA every year. And I want to say that if a student is experiencing a hardship where they're unable to pay back their loans, I do want to say to consider these options with caution. Because in many cases you will continue to be charged interest, and there are also limits to the amount of time that you can have a deferment or forbearance for your loans. All right, so student loan borrowing options. So here you see a list of the federal loan borrowing options for students. You have the subsidized Stafford and unsubsidized Stafford loans. Both of those loans are available to undergraduate students. The subsidized loan is need-based. The unsubsidized loan is not. So the student does not have to have a financial need to take out the unsubsidized loan. Another thing about the unsubsidized loan is that option is also available to students that are getting a graduate's degree or professional degree. Graduate or professional degree. And then next you have the parent loan for undergraduate students, which is also known as the Parent Plus loan. And then that plus loan can also be a Grad Plus loan whenever made out to graduate students. And then the last federal loan option on here that we decided to go ahead and include, since there may be students that are watching this video that may have taken out a Perkins loan, but this is a loan, a federal loan that your school would be authorized to give to you, but that authorization ended in 2017. And so the final disbursements for a Perkins loan would have been in 2018. You also have loans that can come from a private bank. So that would include places like Chase, the Bank of America, or even your local credit unions. And then student loans can also come from charitable organizations. Places like the Scholarship Foundation of St. Louis, we have an interest-free student loan as well. All right, so now we moved on to things that you should consider when you are thinking about student loans before you decide to take out a student loan even. So first is, again, they have to be repaid. This is the one financial aid where students are expected to repay back the money that they borrow. And in addition to paying that back, you may have to pay back more than what you borrow because you've been charged interest at some point of the life of that loan. Also, there are loan options out there that require you to provide a cosigner. So in addition to the student signing on that loan, you have to provide an additional individual to sign to say that they will be responsible to that loan in the event that the student is unable to meet the repayment commitments. Also, there are loans where they require you to do a credit history or a credit check. This is definitely the case for the Parent Plus loan. So if you are a student with the Parent Plus loan on your financial aid award letter, be aware that this financial aid is not automatically available to you. There may or may not be language about that on the financial aid award letter. So the parent would have to pass a credit check in order for that financial aid to be available. Also, your student loans cannot be discharged in bankruptcy. You all know individuals can file for bankruptcy if they have personal debt that they're unable to pay back for whatever reason. That is not an option with your student loans. And this is one of the big reasons why we want to be sure that we understand the loans and the terms and conditions before we take out a loan, and even do a little bit of research to see what your repayment plan is going to be, and if you think that's something that's going to be affordable for you once you leave school. All student loans, students will have to first complete the FAFSA, the free application for federal student aid, to be considered for all student loans. So be sure that this is the first step you're taking. If you're a new student, if you're a student going back to school, start off with the FAFSA. It opens up every year on October 1st. And this is a document that you'll continuously have to fill out in order if you want to be considered for financial aid. All right, so in this slide here, we've broken up the different loan options in between better options versus ones that you should be cautious about. Understandably, loans have a bad rep amongst a lot of students. And so instead of just saying loans are inherently bad, we decided to break them up like this. So first you have your federal versus private loans. So your federal loans are a better option because there are protections put in place for the student to protect the student. For example, you have a fixed interest rate, and with private loans, you may have an interest rate that changes over time. There's also that grace period that you have before you have to start paying back your loan. And then there's also some loan forgiveness options that might be available to you, or an option for you as a student, which may not be available for a private loan, and even deferment and forbearances where you can pause your loan repayment if you're experiencing a hardship and unable to pay back your loan at any given time. Also, when you're looking at your parent loan versus your student loan versus parent loan, the student loan is the better option. First, because it's the student's education, it's the student's investment in their education. But additionally, if you can recall that chart of interest rates that we looked at, the parent loan is going to have a much higher interest rate. And additionally, the parent loan, you'll have to start paying on that loan as soon as it's dispersed. while you have that grace period on your student loans. And the next is the subsidized and unsubsidized loan. And with these two federal loan options, there are a lot of similarities. They got the same interest rate. You also have your 6-month grace period. But the big difference between these two loan options is the amount of time in which the student's being charged interest. So with the subsidized loan, the federal government is giving students a subsidy. So what that means is they're paying the students interest while the student is in school. But with the unsubsidized loan, the student will be charged interest right away. So dollar for dollar, if you borrow $1,000 with the subsidized loan and $1,000 with the unsubsidized loan, you'll be paying back more with the unsubsidized loan because you'll be charged interest for a longer time. All right, so knowing your rights. So first, you have the right to refuse any financial aid that's offered on your financial aid offer. But most importantly, you can refuse any loans that are offered to you or even accept just a portion of the loans. So when it comes to your federal loans, if you're a student and you only need $1,000 more to cover your expense of attending that particular school, but the school has offered you $2,000, you can decide to only take out that $1,000 that you need. And then if circumstances happen to change for you later on during that academic year, that remaining $1,000 is still going to be available to you for that academic year. And the same goes for if you do not accept a student loan. So I say all that just to say students shouldn't feel pressure to accept student loans if you don't need them. You don't have to feel panicked that if you don't take it now, it won't be an option for that year. And if you don't need it all, only take what you need so that we can minimize our debt loads. You also have the right to appeal if your financial aid is being jeopardized because you haven't met one of the satisfactory academic progress requirements, which is also known as SAP. So for example, if you're a student who has exceeded the maximum allowed time to complete your degree, or if your cumulative GPA does not meet the SAP requirements, you do have a right to make an appeal, and each school has their own appeal process. You also have the right to request a forbearance or deferment. And then you also have a right to change your repayment plan. And what goes along with this is you have the right to know how these changes are going to affect your loan balance if they do go into effect. Like I said, when we're talking about the forbearances and deferments, that you may continue to be charged interest during that time, and you are able to seek information to see how that change is going to reflect on your loan. And same if you change your payment outside of the standard repayment plan that federal student loans go into. You also have the right to have your loans discharged due to a school closure. So if your school closes while you're enrolled or soon after you withdraw, you might be eligible to have your loans discharged or your federal student loans discharged. And you do have to apply to be considered for discharge, and there are some criteria you have to meet. For example, you wouldn't be eligible to discharge your loans if you did a teach out or transferred your credits earned at the school that closed to a different school. And so at this point, Teresa is going to take it over for here to talk about reasonable student loan borrowing, loan repayment, and loan forgiveness. All yours, Teresa.
Thanks, Dominisha. As I was listening to you talk about the know your rights, I was thinking about something that also feels important to mention, which is that there's lots of free help out there for any of these things. So if you ever have someone say to you, I can help you change your payment plan, or I can help you apply for a forbearance or a deferment, but you just need to give me a little bit of money, you don't need to do that. So please just be aware that even your loan servicers would not charge you for this kind of support. And there are lots of organizations such as the Scholarship Foundation, and I imagine Prosperity Connection as well, who would be a resource for you at no cost. So we're going to talk a little bit now about deciding what is a reasonable amount of student loan debt to borrow. And I want to just kind of preface this conversation with the fact that, you know, there's a range of what individuals borrow. And so we're going to talk more in averages, and we're not going to give you like a, this is the right number to borrow, period, because that varies for everybody. So right now, according to the Institute for College Access and Success, the average debt at college graduation for a bachelor's degree holder is just under $29,000. So that's the average. There are people who borrow less. There are people who borrow more. But as you are making a decision potentially for yourself or for a dependent, if you have a dependent who's headed to college, there are a number of things that we would encourage you to consider before making a decision about how much to borrow and which loans to borrow. So first, it's important to consider what is the anticipated monthly payment on those student loans. So that's fairly easy to calculate, and there are some tools online that could help you do that. It's a little bit more difficult to potentially determine what is the anticipated starting salary. Most students don't know exactly what kind of job they're going to have when they graduate. They don't know what kind of salary it's going to have, but you can start by identifying these are the potential careers that I'm interested in. I imagine that I may be living in this state, and so you can look up averages for those jobs or majors by state, and sometimes even narrow it in on parts of the state. You may also want to think about what is the anticipated average lifetime salary or income. So to use some specific examples, it's more likely that you're going to earn more as an engineer or as a pharmacist than you may as a social worker or a teacher. So thinking about the potential lifetime earnings that you may have in a given career field can be useful as you make a decision about which loans and how much to borrow. And then we would also encourage you to think about what are your other personal goals and dreams that you have for yourself? What are the other things that you want to do that it will be important to think about long term? So buying a house or having a car, do you want to travel? What are the expenses associated with raising children if you decide that you'd like to be a parent at some point, or if you already are a parent? So these are all things that are part of a bigger review when thinking about how much to borrow. When you think about student loans and borrowing, it's also important to remember that life happens. That's probably something that everybody seeing this knows, because undoubtedly life has happened to you in one way or another. So remembering that life happens and you can anticipate for one possible pathway to be the ideal and to have something else occur. And so at the bottom of the slide, you'll see that really what we would encourage you to think about is, whenever possible, minimizing borrowing. There are certainly moments when students have to borrow more, and there are good reasons to do so, but there are lots of arguments to be made to minimize borrowing at every possible turn. So we want to talk a little bit about loan repayment. So this is loan repayment specific to federal student loans. So borrowers are initially put on what's called a standard repayment plan. The standard repayment plan is 10 years, or what amounts to 120 payments. And so that is the standard that all borrowers are sort of immediately entered into when they leave school. Upon leaving school, borrowers receive a 6-month grace period. And I just want to say that you'll hear that language, leave school, as opposed to graduate, because these things happen when a student leaves school regardless of whether or not they graduate. So students who withdraw either temporarily or permanently will have that 6-month grace period, and then they will be initially entered into that standard repayment plan, which is 10 years. But you have options. So first of all, it's important to know what you owe. I think Dominisha mentioned this particular website earlier. So if you were to go to studentaid.ed.gov and log in with your federal student aid ID, the username and password that you may have used to enter or to file your FAFSA in the last few years, you can find out how much in federal student loans you owe. There's a lot of really good details on this website when you log in. So in addition to knowing how much in student loans you owe, you would be able to see disbursement dates, interest rates, If any loan amount were canceled, you would also be able to find out who the loan servicer is. So if you don't know who your loan servicer is, you can log in and find that information, and you'd be able to contact them through the website. And then it's really important to know that you have options. So yes, there is a standard repayment plan, and yes, that is what borrowers are put on initially, but that is not necessarily what the average borrower stays on. So right now there are 8 repayment plans, and as opposed to walk you through every single individual one, what we want you to be aware of is that there is a lot of flexibility within these 8 repayment plans. The vast majority of them are income driven in some way. And so what that means is the repayment plan is going to look at how much you are earning. It's also going to consider how much in student loan debt you have, and a new monthly payment will be calculated as a result of that. It is possible to have a payment of $0 a month and be in good standing on a federal student loan. So if you are currently in repayment on federal loans and you are worried about your monthly payment, especially so right now, federal student loans, so this is being filmed in May of 2021. Right now, there's an administrative forbearance on all federal student loans, which is essentially nobody is required to be making payments on federal student loans right now as a result of the COVID pandemic. So this has been in place since early in 2020, and it continues to be in place now. The current guidance has it going through September of this year, although it is certainly possible that it will be extended. And so it's important to recognize that right now that forbearance is in place, but if you're worried about what will happen when it ends, whether that's this year or later, there are several repayment plans. We do anticipate that at some point these repayment plans may shift, because honestly, they're a lot, and there would be ways for the federal government to streamline them. And so depending on when you are listening to this, it's possible that there will be additional or different repayment plans. So the last thing I want to talk about is loan forgiveness. So I want to start first by talking about public service loan forgiveness. This is a one that gets a lot of attention. So public service loan forgiveness is for borrowers who work in certain social service or public service positions. So it allows them to have the balance of their loans forgiven after making 120 qualifying payments. So there's a few things to note there. So the first is that 120 qualifying payments would be 10 years worth of repayment. So in order to qualify for public service loan forgiveness, borrowers essentially have to be on one of those 8 other repayment plans in order to have any of their loan amount forgiven. Because if you are on a standard repayment plan, you will most likely pay off your loans right as you are eligible for public service loan forgiveness. You do have to be working at an eligible job for all 120 payments to qualify. So if you were to experience any period of working at a job that did not qualify, or a period of unemployment, it would be possible that you wouldn't have to restart, but you would any payments made during those windows would not necessarily qualify towards the public service loan forgiveness. The big thing that I want to emphasize is that as of today, this program is currently intact. There have not been significant numbers of borrowers who have qualified for loan forgiveness, but the federal government has made significant efforts to streamline and make this process a little bit easier. So my advice to you would be, if you are working at a position where you believe you may qualify, would be to contact your loan servicer ASAP and find out what, if any, paperwork they need to get you enrolled into the program. It is our understanding that any borrowers who are in the program would be allowed to continue in the program, even if at some point the federal government determined that they no longer wanted to offer this. So it's good to be in the position of having the paperwork in and communicating that you're intending to participate. The federal government also has a teacher loan forgiveness program. This one has also undergone some scrutiny in the last few years because it has not been as simple as it needed to be. So again, you want to reach out to your loan servicer. You would have to be making qualifying payments while in a qualifying position. But the sort of punchline to this would be that after making a certain number of payments, working in a qualifying position, you would have the balance of those loans forgiven. So the final thing I just wanted to address is that, again, this conversation is happening in May of 2021. There's been lots of speculation for months now about whether or not the current presidential administration would do anything to cancel student loans. As of right now, that has not happened. We are not aware of a specific policy being discussed, although again, there's lots of speculation. We are aware that I think it's the American Rescue Plan that was passed a few months ago by the current administration. There was some language in there that would allow for any student loan forgiveness over the next few years to be non-taxable, which is not something that has been currently available for loans that were forgiven under some of the income-driven repayment plans. So that is a potential signal about what is being considered, but until there is an actual policy that has been either passed by Congress or an executive order or anything, we are not aware that there will be loans forgiven. And if and when that happens, there will be lots of additional questions from borrowers, and we would invite you to contact the Scholarship Foundation at that juncture if you have questions about how the loan forgiveness would potentially impact your student loans. So that concludes our presentation. This is some information about how to contact Dominisha and I specifically. So again, Dominisha is a student advisor at the Scholarship Foundation, as am I, and you are welcome to reach out to us by email if you have any questions or concerns. But we are not the only members of our team. And so in addition to Dominisha and myself, we are joined by two additional colleagues, Felipe and Robert. And we are available to any of you at any point in time with questions that you may have about enrolling in college for the first time, returning to college, navigating repayment of student loans, or trying to get the student loans in good standing, really anything related to financial aid and college affordability, whether it's for you or a dependent or someone you know. So the Scholarship Foundation's contact information is there. And then in addition, we have a link to our intake form. If you know that you'd like to speak with a student advisor and you'd like for us to reach out to you, if you fill out that intake form, a member of our team will follow up with you and see what they can do to assist or support you. So that concludes our presentation, and we appreciate you taking the time, and we hope to hear from you if there's anything further we can do to support you.
Great. Thank you.